Great.
Hello, fellow investors. Sorry, I didn't have a lot of time recently. I'm going to be quite busy till the end of April, so I'm not going to post a lot of videos. But however, the market is up quite a bit despite the interest rates being extremely high. So I wanted to take a look at some short opportunities to maybe diversify my portfolio a little bit and to diversify risk. And again, since the market is up quite a bit, despite interest rates being extremely high. Well, we have quite a few overvalued stocks. I initially wanted to look at Beyond Meat, and it looks quite overvalued, and the financial statements look extremely interesting. However, I was following one of Canadian stocks from the similar industry, a Very Good Food company that is currently going bankrupt. It is similar business as Beyond Meat, so it's a novelty food market. So I wanted to first review how the Very Good Food company went bankrupt, or like they are not bankrupt yet, but they are essentially are. So I wanted to review the short history of them going bankrupt and why, and hence the reason why I think Beyond Meat is also going the same route. It'll probably go bankrupt, or it'll be repurchased by some bigger company, like let's say Kraft Food Company. So we'll see. So anyway, let's start from reviewing the Very Good Food company. It's a very interesting story. So let's start from looking at their last annual financial statements, which they filed in 2022, which was for the year ended December 31st, 2021, compared to 2020. So on these financial statements, we can see that there was a tremendous, the company recorded a tremendous growth. The company grew at a rate of, well, essentially more than doubled the revenue. So they had $4.6 million in revenue in 2020 and $12.2 million in 21. So that's great. That's like on the level of Tesla. However, simultaneously, if we look at the expenses and the cost of sales, procurement and fulfillment expenses, and understand procurement and fulfillment, I'm not going to go into the notes and details because I think it's insanity at this point. Like with this company, just everything is quite straightforward and looks ugly as it is. So procurement and expenses. So we need to deliver food items, and then we need to modify them to produce our food. So our sausages, hamburgers, like meatless sausages and meatless hamburgers. So our cost to deliver, to get the food and transform it into the actual food item is more than the revenue that we received. So for every dollar of revenue that we get, we spend more money. So that's an insanely bad business model. It just doesn't work. So for example, it's like, give me $1, I'll give you $1.50 back. I need you as a client. So so for every dollar that you are getting from a client, you're giving them back 1.3 or $1.5. Well, this business model is going to run for as long as you have any cash left. As soon as you don't have any cash, the business model doesn't work. So, but the disaster doesn't stop here. We also have marketing expenses. We also have research and development expenses, which were $500,000 in 2020, which were $2 million. Okay, we need to modify beans into meat-like tasting product, and we spent $2 million on that. Again, I'm not an expert in food business, so maybe it does cost this much. Then I have so essentially the company. So to run these losses, so again, just to produce those burgers, meatless burgers, and to get the food items and manufacture those meatless food burgers, we are already generating losses. And despite the higher sales, we still generate losses in 2021. Then to generate this tremendous revenue growth, we spent $32 million on general administrative expenses. So these are guys that are just sitting in the office and doing what for $32 million. These are lawyers, accountants, guys that are probably marketing the stock on the stock market so that like investors buy it. I don't know, where did the $32 million go to? I don't know. Then we need to, again, to sell this stuff to generate this revenue growth, we need marketing expenses, so $11 million. So we have $12 million of revenue and $11 million of marketing expenses. Doesn't work to me. So obviously, so the company generated, after all these things, the company generated $55 million of losses, or 53 cents per share. Apart from it all, the company also diluted the ownership interest, shareholders' ownership interest it issued. Well, it almost doubled the amount of shares. So, so it doubled revenue, it doubled the amount of shares. So I guess that's these guys over here. They that was the financial ingenuity and engineering for $30 million. That's so the investors, the new investors needed to get the value. So that's the value here. So if you look at the balance sheet, so what we had on the balance sheet, the company had $22 million in its coffers, $2 million of accounts receivables. Then it had inventory. Again, these are highly perishable goods, but let's keep it at this $8 million of highly perishable goods. Prepaids and deposits, more likely these are real estate deposits, so you have them but you don't, so that's probably a negligible item. But again, let's assume that all of these items are $30 million, because again, in case the company goes bankrupt, you are not going to recover these amounts. These are lost assets. Then long-term assets, rights of use, again, relate to real estate, and if the company goes bankrupt, these are lost things. Property and equipment, I am not going to go into these details, but even if it's equipment, it's very unlikely that you are going to generate used food equipment for this much money. More likely you're going to sell it at a huge loss. But well, let us assume that you're going to sell them for $15 million. Prepaids and deposits, again, you can forget about these things. The first financing costs, again, forget about this cost. So about $30 million in reality of short-term assets and $15 million of long-term assets. So $55 million of assets in total, while we have $10 million of real liabilities. And well, you can count all of these liabilities pretty much as real. So derivative liabilities, again, I'm not going to go into the details, but probably no one wanted to finance the company, so they had to come up with some sort of creative financing to finance themselves, which is again part of the other disaster lease liabilities. And so doesn't look very good, but let's so essentially the company does have some assets. Roughly, let's say $20 to $30 million of cashable assets that can be used. However, again, we in the meantime, we're generating $55 million of yearly losses. If we go down to the cash flow statement, cash flow from operating activities, $41 million. Cash flow from investing activities, again, we know how those investing activities work. The cash essentially disappears. So $57 million of losses. So essentially, at the end of 2021, on December 31st, 2021, the company was already near bankrupt. Like you could see that it's just an unsustainable business model. So it generates $55 million of losses, or in reality, $57 million of cash losses if you look at the cash flow statement. And simultaneously, we have roughly, I don't know, 22, 24 $30 million of cash or cash-like items that you can use to offset the oncoming losses. So if we switch to the quarterly financial statements, how the whole disaster kept on transpiring, obviously, again, the whole business model of the company, that just doesn't work. So the company cannot really do anything. Like the best this company could do, it could simply stop working. We just say, okay, guys, everybody is fired. Everybody, especially these guys, like they have, like, I'll include R&D guys as well. They need to go, like, just fired, almost all of them. Maybe would keep like a couple of guys here, maybe, but these guys have to go. And if, again, generate zero sales, if you have zero revenue, well, you're not generating losses any longer, and then you're free to keep this cash. Just you need to incur some expenses to fire all those guys, and you get to keep the cash. So you get to keep the shareholder value. But as long as you keep any operations, just any operations, you immediately start generating losses. So stop operating, like do whatever you want, just don't run your business, because your business generates losses every time it generates a single dollar. So just stop it. So it's not sustainable. So how things transpired later. Obviously, the company generated losses over the next few quarters. So this is the last quarter they reported for, September 30th, 2020. So the cash on hand was almost $708,000. So great flows. Inventory, $9 million. Again, perishable goods. I don't know what are you going to do with this inventory, perishable goods. I know, like, sounds very, very suspicious. Did you really count it? How much of it is was eaten by mice? I don't know. Looks very suspicious. But anyway, let's keep it at that. Can you sell it for cash? For how much? For $9 million? I doubt it. But anyway, so $708,000 of income. We are generating $57 million of losses per year. So these items kind of could save us. Then again, these items relate to the real estate rent. These are real estate rental items, so you cannot really recover them. They are more likely gone. Loans, current portion of loans. Okay, so current portion of loans. This is great. So we need to, over the next 12 months, the company needs to repay $7 million. What do we have? We have $708,000 here and $9 million, hopefully, if it's all good over here, and $1.5 million in accounts receivables. And we have $7 million in the upcoming payments to creditors. So then we have $3 million in regular accounts payables, and current portion of lease liabilities almost $2 million. So well, we also have derivative liabilities, $6.4 million. I don't know how those strange people are who decided to finance this company, but strange and very, very brave people. So, but they well, kudos to them. Anyway, moving forward. So it looks like a disaster. So let's continue with our disaster. So revenue, finally, income statement. That's the interesting part. So thanks God, the revenue is dropping. The revenue is going down. So if we look at the revenue, so we generated less of revenue for the third quarter of 2022 compared to 2021. So we must have generated smaller losses, which is great. So again, as I said, the company has to stop generating any revenue at all, because whenever it generates revenue, it generates losses and procurement expenses. So revenue, procurement expenses. To generate this revenue, we had to incur $2.5 million of procurement expenses. So again, guys, stop it. Stop doing whatever you're doing. It's stupid. Fulfillment expenses, again, sorry, stop guys doing whatever you're doing. General administrative expenses. So the guys in the suits and ties eat $4.6 million of expenses while generating $1.8 million of revenue. Fire those guys. But again, it looks like they have fired somebody. Marketing expenses, again, good, but you need to stop like operating at all. Good. Versus R&D expenses, well, kind of decrease them. Okay, so things are better, but we're still generating $7 million of losses, change in fair value of derivative liabilities. This is okay. I'm gonna keep it. This is not really a cash item. So we generated roughly 6.8 finance expenses, $7, $8, $9 million of cash losses, or $1.5 million losses if you take into account change in fair value of derivative liabilities, which is a non-cash item. So which is a positive non-cash item. So again, very suspicious item, and it doesn't help you as a shareholder. It doesn't build any value. So if you look at the cash flow statement, it's going to look more disastrous. So cash flow provided by operating activities. So in the 9 months period of 2022, we lost $23 million in operating activities. Great. And $3 million in investing activities. So $25 million in 9 months. So we are losing what? $3 million per month. So essentially, the company has to be broke by January, February 2023, which is right now, and they are going broke. So that was a short review, or maybe a long review of the very, very good food company. However, I am not interested right now in the very good food company. I'm interested in shorting Beyond Meat stock. So again, if you look at the very good company stock price, it was constantly decreasing, although it had these bumps up. We will talk about these things later. These were probably shorts covering. This happened. I'm sure there was a lot of short interest over here during this time. So some of these shorts were covering, some of them were probably overextended. So this is kind of inevitable in the situation. However, if we look at again, the stock price was moving down with the financials because the company is draining money like fast, really fast. Every quarter, it's just draining capital, and sorry, I forgot about it, and increasing diluting the shareholder value, because the only way this company could generate any cash to put over here is through the sale of the shares. So for as long as the share price was somewhat good, the company could sell shares and generate extra cash. Same thing goes for the for Beyond Meat. So it is also decreasing in value, but we are standing currently at $17 per share. Simultaneously, the price to sales ratio for Beyond Meat is currently at around 3. For example, for Kraft Heinz company, which is a superior business with very good balance sheet and very good financial statements, and that has been in existence for a while. It has a lot of trademarks. It has a price to sales ratio of around 2. Price to sales ratio of Beyond Meat is 3. So it's valued 50% more than Kraft Heinz. So, and well, let's look at the financial statements for Beyond Meat. What's going on there? If you go to Beyond Meat's website, the first thing that strikes me is that I cannot see the most recent financial statements right away. All I can see is their stock quote. And supposedly that's because the stock price should be doing quite well. And this is, again, an innovative industry, and I should not be interested in the financial statements. I should be interested in their share price and the news that are coming out and all this interest and the future. Not the financial statements. That's for stupid accountants, stupid and boring accountants. So, however, if we search a little bit, we'll go into the financial statements, and let's start from the last annual financial report. So let's look at Beyond Meat financial statements for the year ended December 31st, 2021. So cash and cash equivalents. That's $733 million. So the company is bigger than the Vancouver, BC company. It's probably 10. It was probably 10 times bigger. But numbers are quite similar. You just need to multiply them by 10. So $733 million of cash in the bank account, $43 million in accounts receivables. Inventory, again, these are perishables, $241 million. So $1 billion in total short-term assets. Then we have property, plant and equipment, which is great, $200 million, but it's really hard to sell. Operating with rates of use. Okay, these things are hard to sell. Okay, $1.4 billion of assets. Almost no liabilities. Great. So the bank statement, the balance sheet looks great. So looks quite strong. Let's look at the income statement. On the income statement, we can see that the company, again, in 2020, generated $400 million in revenue. Cost of goods sold were $284,000. So gross profit was $122 million. So the company, unlike the Very Good Food company, it does generate gross profit margin. The Very Good Food company, right from this place, was losing money. So it does make, based on these financial statements, it does make sense. However, if you look at this selling, this could be just tricky accounting being done by the Beyond Meat. So if you look at this expense, selling, general, and admin expenses, and if, let's say, you move $100 million to over here, because I don't know, why do you need, why do you need $130 million per year to spend on administrative stuff in a food business company? I don't really understand it. I would probably suspect that part of the expenses that should have gone really over here went over here to hide the some of the real problems. So essentially, the company, but in the end, the company generates still manages to generate losses. Whichever way you run these expenses, it still generates losses. So on $400 million of sales, we generated in total $52 million of sales. So almost 12 or 15% of the revenue. In 2021, again, we do have gross profits, which is nice, but the selling, general, and administrative expenses went up even higher. By the way, the revenue growth is not this is much smaller than in the in the Very Good Food company. If you remember, the revenue increased more than 2 times for the Very Good Food company from 2020 to 2021. Over here, it just went up by what, 15-20%, 15-18%, which is a good growth. But selling, general, and administrative expenses, again, I suspect part of them, at least a part of them, in reality, belong somewhere over here. Is just creative accounting done by the company to hide the real problems in the company. So on $464 million of revenue, we generated $180 million of losses. So again, the best this company can do is just stop doing whatever it is doing. Guys, just stop doing whatever you're doing and keep, like, you almost have $1 billion of cash. Like, just keep it. Seriously, you have no liabilities and you have $700 million of cash. The best thing you can do is just take this cash, like, stop doing whatever you're doing, just stop it completely, and distribute this cash to your shareholders. That's the reason, because whenever you do anything, you generate losses. Well, obviously the company also prints a lot of shares, so we're diluting the shareholder value. So whatever you have over here, your share is constantly declining because the company prints more shares. So please distribute it. Don't print any more shares, because you are just stealing more money from the shareholders by doing that, and you're not doing any good by growing your sales, because each new sale generates more losses. Like, you had smaller losses in 2019, just go back to 2019 level, because 2021 level just doesn't make any sense. Like, it's stupid. So statement of cash flow. On the statement of cash flow, it looks even more disastrous. So on the statement of cash flow, net cash used in operating activities, that's a disaster. So I suspect there is a lot of creative accounting in the Beyond Meat financial statements, because if you look at the, so over here, we have a loss of only $182 million, while over here, we have just cash flow provided by operating activities of minus $300 million, almost like 50% more than the income statement loss. Then we have cash flow from investment activities, and we know where those investments go. They go into something that is extremely hard to sell or near impossible to sell, $147 million. So in 12 months, in reality, we generated almost $500 million of wasted cash. Let's say $50 million of it is recoverable. So $400 million of cash. How much cash do we have? We have $733 million of cash. So if our next year, 2023, is going to be as good, we're going to run out of almost all cash, or close to like 70% of all our cash, and we're not going to have any assets. And so, and we need to stop growing revenue. So it's a complete disaster. So let's look at the quarterly financial statements. On the quarterly financial statements, what do we see? So cash. So again, those financial statements that we were looking at were at December 31st. These financial statements are as of October 1st, 2022. So 9 months has passed, and so again, we're generating roughly $400 million of losses, and should generate roughly $400 million of cash losses in 12 months. Let's look at the cash situation at the end on December 31st, 2021, $733 million. Cash situation in 9 months, $390 million. Let's move forward. Accounts receivables, almost not there. Inventory, again, this inventory, I can, how do you do inventory count? So very suspicious number, and 2 questions. How do you do inventory count? Let's assume properly. It's a perishable inventory, so it may disappear tomorrow. Again, these assets are almost non-existent, so probably 600,000, like, okay, $600,000 to $700,000 of real assets, not $1.1 billion. But okay, let's assume $1.1 billion. but again, at least part of it, of these assets are not transferable or very difficult to transfer to cash. Again, no liabilities, fine. Maybe we have better income statement. Let's look at the income statement. So for the third quarter of 2022, we generated revenue of $82 million, which is roughly 20% less, or more than like 24-25% less than in previous year, which is great. Well, our revenue is shrinking, so our expenses must be shrinking as well, so our losses must be shrinking. So that's a great idea, but we just need to bring it down to zero to stop this madness. So gross profit also. Wow, that's finally coming the moment of truth. So finally, we are admitting that by selling goods, selling this meatless meat, we are generating losses. We are finally admitting it. Selling in general admin expenses, $55 million. So we had a revenue of $82 million for the third quarter, and we had admin expenses of $55 million. Great. Nuts. That's an admin company, not a food manufacturing business. Maybe I don't know, like what do these people do? They're obviously not selling. Well, here's the research and development expense. Oh, this is selling general expense. Okay. Restructuring expense. Okay. Stop doing whatever you're doing. Just stop selling stuff. Just distribute cash to the shareholders. They're not going to do that. So we generated $100 million loss in just third quarter, while the loss in the third quarter of 2021 was $54 million. So it's a disaster. So for the 9 months period of 2022, for three quarters of 2022, the company generated loss of $300 million. That's the income statement loss. I'm sure I haven't seen the cash flow statement loss, but I'm sure it's even bigger than this, because it looks like this company is playing around, could be playing around with the numbers. We have a negative gross profit again, so which tells, just like in the Very Good Food company, we have the company needs to stop to stop making losses. It must stop selling whatever they're selling. So again, that's unsustainable business model. So gross profit loss, R&D expenses, almost $50 million in 9 months. Selling general and admin expense of $200 million. Please explain this to me. So, and again, after all these things, we have a loss of almost $300 million in 9 months of 2022, or $4.7 per share. The company has almost stopped printing shares, so that's great. But again, they're draining cash very fast. So in 9 months, we generated $300 million of losses. And over here, if you look at the balance sheet, we have $390 million of cash left. So the company is going to run out of cash in about 9 to 12 months. So by about September 30th, 2023, Beyond Meat is probably not going to have any cash at all, and it's going to be very close to the same situation where the Very Good Food company is at right now. So this looks very, very bad. Let's look at the cash flow statement. On the cash flow statement, what do we have on the cash flow statement? Cash flow, net change in the net cash used in operating activities. So for the 9 months period of 2022, we used up $270 million to operate the business. Disaster. And $70 million to invest. So purchased property, plant, and equipment, $60 million. Payments for investment in joint ventures. So this is not recoverable, almost for sure. This is maybe is recoverable, but very doubtful. So again, you invested into property, plant, and equipment, then that generates you gross profit margin loss. So you spend $60 million to generate more losses. Okay, I don't understand this business model. So overall, the cash drainage for 9 months period is $340 million. So $340 million, which is slightly more than whatever loss they're showing here. So it's probably like over $5.5 per share loss in 9 months period. So, and which means $340 million. Yeah, the cash is going to be gone in 9 months. Maybe if they do something, the company is going to last maybe a year and a half, 2 years, but somewhere around in about 12 months, the company is going to incur some serious problems. The way the company can survive is by potentially printing more shares. Again, Beyond Meat is valued quite generously. If you look at, for example, Kraft Heinz price sales ratio is just 1.9. If you look at price sales ratio of Beyond Meat, it is 2.9. So the company is valued quite generously. So if I were the management of the company, I would sell right now as many shares as I potentially could to devalue, to generate cash, but in the process, I'm going to devalue the present shareholders. Simultaneously, I'm going to generate quite a few losses. So let's say if, again, return to the financial statements. So if in 12 months, I'm going to spend $300 million. So this number is going to, I'm probably going to spend more, but let's assume I'm going to waste $250 million. Let's be more conservative. Let's assume that those restructuring costs that the company is running of around $7 million are going to work out, and the company is going to decrease its the speed at which it's draining money. Or the company is, nevertheless, the company is generating gross profit losses. So for every dollar it sells a product for, it generates losses. So it needs to stop operating. To stop generating losses. So let's say they generate smaller losses of $250 million. We're going to be left over in the next 9 months. So we're going to be left over here with by June 30th, we're going to be left over here with roughly $150 million. And these items, I don't know how do we value them. Let's value these items at around $300 million. So as the best case scenario, I would say that I would value this company at around $500 million by June 30th. So right now it is being valued at $1.1 billion. So by June 30th, I'd say it is very good chance that this stock price is going to go to half, like it's going to go down to probably around 8, just because it's the company is a going concern issue, and it's just going to drain all those assets that it has. So it's just not going to have those assets. That's it. Why would you give more money for less stuff? So $8 by June 30th, maybe. If my key concern is that S&P 500 is valued right now quite generously, and with interest rates being as high as they are right now, I would suspect that things in the market could go down could behave very unpredictably. So again, I think it's a very good shorting opportunity. However, where is the key danger? The key danger is in the short ratio. I believe the short ratio for the for Beyond Meat is around 30%, which is quite high. So whenever, and I would expect that some of these shorts, you could expect these spikes from once in a while. I'm sure that these are shorts covering whenever prices start going up, and some of the shorts are not prepared to withstand these small tiny price increases, and they have to cover. So however, if you can hold this short position, safely hold this short position for the next 12 months, this looks like a relatively safe short bet. And it looks like you could make like around 50% on your money during the next 9 to 12 months. So if you like this video, please subscribe. And hopefully I'll post more videos. Again, I'm going to be quite busy till the end of April, but other than that, I'll try posting more videos like this. Cheers, goodbye.